Hello, and welcome to this week's edition of Your Wealth Matters, brought to you by the team of Your Wealth Advisors. I'm your host, Kristen Oakley, and joining me in the studio, we have Ryan Cunningham. He is the founder, and his beautiful, lovely wife, Paige Cunningham, who is the co-founder. We're so glad you're tuning in this week. Each and every week, we put a lot of thought into conversations that make a difference for you in your retirement. And the title of today's episode is Don't Try This at Home. By the end of today's show, you are definitely going to understand what we mean by that. But before we dive into what we're going to be talking about today, Ryan, Paige, so good to be here with both of you.
Yes,
Thank
great
you so
to
much
be back.
for having me. Of course. Well, for a lot of our viewers that are newer to you, of course, y'all are married, you have your beautiful children at home, you run this business, you serve so many clients. I mean, it's amazing. You do so much in such a short amount of time. It's awesome.
She really does.
We try.
It's a team effort, right?
It is.
Absolutely. Yeah, she's a rock star.
No, for sure.
I just show up.
Oh, no. I think there's a good cohesive synergy happening,
we're a good
right?
team.
A good team.
We do make a good team.
For sure. Well, again, today's show is all about something that we want you to be aware of that you should not be trying to do at home on your own when it comes to retirement planning. And to set the context for today's show, I thought I would share this quick story, which I know I've shared with you all, but folks ask me a lot what it's like to be on the show, work with you all. And once they find out that that's what I do, they often ask me their own financial questions. So I was having a conversation with a dear friend who's 65, her husband is 70, and they started asking me some questions. So in turn, I asked them questions about their financial plan. And they were working with a financial advisor at the time, someone from a corporate firm. And I said, well, one of the things you really want to start planning for are your RMDs. And they both looked at me and said, what are those? We've never heard of this. Our advisors never talked to us about this. So that's what we're going to be talking about today, because it's shocking how many folks are completely unaware of and unprepared for RMDs. Now, when I first got into this industry, I was jokingly told that RMDs stood for really mean and dastardly, or retirement mass destruction.
Yep.
That's not what they stand for. So go ahead and define, what does RMD actually stand for?
Yes. So RMD actually stands for your required minimum distribution out of your qualified accounts that this guy requires.
Yes, let's introduce our third person on set here.
This is our fan friend, Uncle Sam. And he's here today because he plays a vital role in these RMDs and taxes and retirement. And we didn't want it to go miss that he's here with us, but not necessarily on our side.
I know, and that finger, he's just pointing
He's
at
pointing
us.
it
Get that
right
finger
at you.
away from me.
Business.
Yeah, he's coming for you.
Means business.
So these required minimum distributions help folks understand why they're so crucial and critical, because just like the name says, it's required, it's not optional. So what is the big deal about them?
Yeah, the big deal is they're required. Right? And what that means is that it doesn't matter if you want to take them out or not. If you don't, then the government is going to say, well, hang on a second, there's a little penalty for that. And Uncle Sam here is not just pointing at you because he wants a little bit of it. He's pointing at you saying, in the event that you don't take it, we're going to penalize you 25%.
Yeah, and just to highlight, the penalty a few years ago used to be 50%, 50. How nice of the government. They lowered it to only 25%. Here's the point. We don't want anyone paying that penalty, and that's why we've devoted today's conversation entirely around how RMDs work, what you need to understand about them so that you don't get inadvertently hit with that unnecessary penalty. So let's start with the basics, because RMDs are something that are going to affect anyone and everyone who has money saved up in qualified accounts, also known as tax-deferred accounts, so traditional 401ks, traditional IRAs, things of that nature. So what is the RMD calculation based on?
Yeah, so the RMD calculation is based off your age, which essentially is your life expectancy, your account value, and your RMD actually goes up every year.
Right, because our age is changing every year, and so therefore the calculation doesn't stay the same. Yep.
Which in turn means you are required to take larger amounts of money out of these accounts. And please note that this comes in as ordinary income.
So not only you have to pay the tax on the money you take out. So here the government's saying, okay, we've let you save this money tax deferred. You haven't had to pay any tax on it yet, but now you reach this magical age, which currently for most folks is 73. If you're born after the age, or after the year, I should say, of 1960, it's 75 as the rule currently stands, but we know it could change, right?
They're changing.
So that's when you have to start taking this money out. You have to pay the tax on it,
Oh, yeah.
whether you need it or not, and it's taxed as ordinary income.
Yes.
Yeah, you know, we had a client come into the office at the end of last year. As we were doing all of our RMD plans and really helping people figure out when and how to take it, and she was adamant that she didn't need it.
Nope. Didn't want to take it.
It doesn't matter.
She's like, I don't want it.
No.
Yeah, I
keep
have
it.
enough income, is what she kept telling me. I don't need, this is for my kids.
Yeah.
And, you know, unfortunately, she's fairly new to us, and she's brand new to 73. And so we're having to explain to her for an hour that it doesn't matter that you have enough income. If you don't take this out, there's a 25% penalty on that.
Right.
And just getting the grip, if you will, of having to take that money out is something that a lot of clients and a lot of folks just don't know is required.
Right.
Right? It's not just that it's required. They're actually then shocked about how much they are required to take out, and then what that does to their other income sources or their taxes.
Right. Yeah. Well, and it typically starts out about 4% that first year, right? So if you do the math, right, thinking about how much you have saved up in these tax deferred accounts, 4%. But then to your point, Paige, this calculation changes every year. The amount you have to take out goes up every year because we are constantly getting older. Yeah. So, all right. So let's, before we wrap up this segment, it's important to understand too when the first RMD is due by, because this is something that has changed a lot in recent years. There's a lot of confusion out there. So can you shed some light on what the rule currently states?
Yeah, so it's the year that you turn 73, right? So if you turn 73 this year, it doesn't matter if your birthday is in January or if it is in December. The law states that you have to take it out by the end of the year. However, the first year they do give you a little caveat. It says that you can wait and not take it out that first year, but you have to take it out before April 15th of the next year. And in the event that that is you and you say, well, that's what I want to do, just know that that does not eliminate that distribution that you're also required to take out that year. And so this is really an ever-changing number. As we said at the beginning of the presentation, or the beginning of the show rather, it moves up to 75. Well, just 6 years ago, it was 70 and a half.
Right.
So this number is constantly changing, but the number that you need to know is the end of the year, by December 31st,
Right.
that you have to take that money out.
Yep.
And there's a couple of caveats that I think we'll get into a little bit later in the show of what that number is and what it's based upon, but that can also be a little bit tricky because as Uncle Sam here is bobbling his head at us right now, he is coming for it and coming for you, and we want to make sure that you are prepared and that you know what that requirement is going to be.
Yes, for sure. I'm so glad we're having this conversation because like I said, just like my friends, they had no idea and they were already working with another financial advisor. And so this is so crucial because the sooner, as you're going to see throughout today's show, that you can plan for these RMDs, the easier it's going to be able to be for you. Success in retirement is not about how much you have, it's about how much you get to keep. And one of the biggest detriments to protecting your wealth is taxes. And a lot of folks are completely unprepared for that. So what would you say to someone who maybe is watching and going, yeah, this is news to me. I didn't know about RMDs, that no one's talking to me about these things. And they are realizing, okay, this is a little more complicated than I thought and I could use some help.
Yeah, I would say to those people, please give us a call. We would absolutely love to sit down with you, talk you through retirement planning, put a plan in place for you that will work for you and help you keep as much of your money as you can.
Wonderful. Well, Paige, Ryan, thank you so much. That number to call to start your journey and schedule your time to come in and receive your complimentary written financial plan is there for you on the bottom of your screen, 844-411-3050. Or if you'd like to connect online, just grab your smartphone. You can scan that QR code in the bottom right-hand corner of your screen, and that will get you connected as well. Don't go anywhere. When we come back, we are going to walk you through the 6 most common traps that we see folks fall into when they try to do their RMDs on their own. You want to stick with us to find out what those traps are so you can avoid making these same mistakes. Stay with us.
Hey,
out of school, I was an accounting major, and my plan was to go into being a CPA. And then I kind of dove into an internship at a financial firm, and then later learned that I loved helping people that way. I actually worked in a field prior to this where we were not independent and we were captive. I did not like that because I didn't feel like we were able to provide the clients exactly what they needed. We were told what it was we could sell them and had to make it fit their needs. And we just didn't agree with that. And so going on to an independent firm, now we can offer them whatever it is that we feel best fits their needs. And I think that's been a game changer for them. Peace of mind is everything. People understanding that they're not going to outlive their money, that there are ways to re-strategize their plans, and there are multiple buckets to fulfill to make sure that every aspect of financial retirement is covered. And also want them to feel like they are noticed and they are one of us, and they aren't just another person in our firm. That's huge to me. I often refer to our firm as a boutique firm. I think of them as my family. Like, I would truly invite my clients to my dinner table with my children. I absolutely adore my clients, and I just love being able to help them in any way that I can.
Welcome back to Your Wealth Matters. I'm Kristen Oakley here with both Ryan and Paige Cunningham from Your Wealth Advisors, and we're so glad you're joining us today. If you're just tuning in, the title of today's episode is Don't Try This at Home. Everything you need to know about your RMDs, those required minimum distributions. And again, if you're just joining us, we have a fourth person on set over here in between Ryan and Paige. Uncle Sam has joined us today because this show is really all about his rules and his requirements, right?
Yeah, and this is the perfect illustration of him pointing the finger because he's coming for it.
Exactly.
And you need to be prepared for it. And I think that as we have said in other shows, and as we will say in future shows, education is the most powerful tool that you have in retirement. And so I'm excited that we're talking about this stuff today.
Yeah, for sure. Well, as I teased before the break, what we want to do now is walk you through the 6 most common traps that we see folks fall into when they try to do their RMDs on their own. And by the end of today's show, you're definitely going to see why we say don't try this at home. So you guys ready to dive in?
Let's do it.
Okay. So trap number 1 is deferring your first RMD until April 1st of the year following the year that you turn 73. So even though the law allows that, technically for your first one, you are allowed to delay it till April 1st of the following year. Why is that a trap?
Yes, great question. So although it sounds great that you can defer your first one because you can put off bringing in ordinary income, however, you are then to also required to take your second one.
That same year.
That same year. So if you have $1 million retirement account and you're taking out your RMD, or originally that would have been a $70,000 RMD, right?
Yeah.
Or 40, I'm sorry, yeah. But then you double that, right? And then say you have any other income, if you have rental properties or anything else, then you're adding all that in and you are certainly in a higher tax bracket. And that's what we're trying to avoid in retirement.
Right. So you were saying that you never typically recommend that somebody defers, right?
No, we don't, just because it can. One, the biggest factor is it comes out as ordinary income, right? And then if you're now required to take double
of the same
what
year,
you thought you were going to be taking, well, chances are you might be going into a new tax bracket, right? The other piece about that is some people, not going to name names of who these people would be, but they would forget.
Yeah.
And they come back and they look at it and they come to us, well, I've already taken my distribution this year, not remembering that they're required to take it the year before. And so I like to keep it as simple as possible for our folks and for us, to be honest, because keeping up with that, you don't want to miss it.
No, for sure.
You don't want him getting in your pocket for another 25%.
Exactly. Because then again, if you're just tuning in, you missed this earlier, not only are you going to have to pay the tax on the money you take out in the form of the RMD, but if you get it wrong, you're going to be hit with an additional 25% penalty on top of that. So that's what we're trying to avoid. All right. Well, trap number 2, failure to adjust your RMDs if you're still working. This is fascinating. Talk about how that can be a trap.
Yeah. So, the one thing that a lot of people have come in over the years and said is, well, I'm still working. I don't have to take out my required minimum distributions. I don't need it. I still have my income. And unfortunately, Uncle Sam doesn't care.
He wants his money too.
Right.
Yeah. And so, it's while there's some great options of not having to pull from every single account that aren't in group plans in your 401ks, your 403bs, or your 457s. If they're in an IRA, you can add up the total of all of your IRAs and take your distribution from one of your accounts.
Right.
If you have multiple, you can aggregate it.
Right.
But if you have that 401k or a leftover 401k that's still in the 401k, guess what?
Don't miss it.
You're required to take it from that account.
Yep.
And so that is a big misconception that,
Mhm.
you know, a lot of people don't realize. They think that, well, I'm still working, I don't have to take this out.
Right.
Right. Or two, I can just take it all out of one account and not worry about the
Yeah.
other accounts. And
Yep.
I think that's where they get confused.
That's where you
a
get
lot.
I was
into
going to
trouble.
say, because you might, depending on the rules, and you have to check, it might be that you don't have to take the RMD for the 401k that you're still contributing to, that
Correct.
it's active, that you're
Yeah.
working. But if you've left behind old 401ks, we call those stray 401ks, right? At previous places of employment, a lot of folks have, and you don't take the RMD from those accounts, wham, there's Uncle Sam, 25% penalty. Yeah.
Yeah, that's kind of one of the things that we're big proponents of keeping it simple.
Mhm.
I know I've said it 100 times and I just can't stress enough, but simplicity is king and education is king.
Yep.
And that's one of the reasons we encourage
Right.
old 401ks to be moved out into individual accounts, retirement accounts, because you have more options,
Yes.
right?
Yeah.
And you have more control
control.
over that money.
Right.
And so it's just an extra part of really putting together that plan and making sure that one, your money's working for you,
Yep.
but two, that you don't have something fall
Through
between the cracks,
Right.
and then you get another little bill.
Yeah, for sure. We don't want
Surprise.
that. Yeah, no, that's not a good surprise. We don't want that, right? All right. Trap number 3, failure to use the account value as of the prior December 31st in the calculation. How often have you seen that mistake occur when folks do this on their own?
You know, unfortunately, I see it all the time. And the biggest trap that it comes into is what happens if the market has gone up or down,
Mm-hmm.
right? Down
Right.
specifically.
Mm-hmm.
Because they take the value from the previous year in. So from December 31st of the previous year is what the value is that the government and the IRS bases your required minimum distributions on. So let's say that last year your value was $500,000, but today it's only worth $400,000.
Mm-hmm.
You're required to take your distribution off of the 5.
Right. Not what the account value
Not
is
what
today.
it says today.
Right.
Right? Now, if the markets are going the opposite direction and you're gaining, right, then that's in your favor because
Right.
that's less money. But even if you don't know and you take more than you need, it can also put you in a difficult situation of, well, now maybe you're in a new tax bracket.
Yeah.
Mm-hmm.
Or now maybe you have an IRMA situation. Or now maybe, who knows
Right.
what it is, right? And so knowing and understanding what is available to you and the rights, options, and entitlements to you through the law is very critical.
Yeah.
Yes, very, very crucial for sure. All right, trap number 4. We touched on this before. This is kind of similar, but a little bit different. Again, it's failure to take your RMD from the proper account. So again, folks often have multiple accounts. So let's touch on those rules again, just to make sure folks understand.
Yeah, so again, when it comes to your IRAs, if you have multiple IRA accounts, you can do a cumulative number and take it from just one account. However, you cannot do that with your 401k, with your employer plans, 403bs, 457s. Those have to come from individual, each 401k that you have with previous employers, although there are some exceptions if you're still working and contributing to a specific 401k.
Right. And I think that's awful. Like I've heard
I
that horror
know.
story where folks took the right amount,
Yeah.
but they took it from the wrong
account.
Government doesn't care. They say, wham, there's that 25%
Yeah.
penalty. So again, it's just so many ways this can go wrong.
Oh, I know. And that's why working with someone is so important, so that they can help eliminate that.
Yeah, for sure. All right, moving on to trap number 5. We touched on this earlier as well, but failure to calculate your life expectancy annually.
Yeah, unfortunately, as we age, our life expectancy tables change. And as those change, guess what else changes? The calculation on how much money you're required to take out of these accounts.
Right, so it changes every year.
Every single year. And you would think the longer you live, the less that you would be required to take out, but it's just the opposite of that.
Mhm.
The government says the longer you live, the more we want, because ultimately, what are they wanting? They're wanting to get into that bucket of money and to be able to tax dollars that they've never been able to tax before.
Right.
And so, you know, that's one of the unfortunate aspects of retirement is that you do have to stay on top of a number of things in your required minimum distribution, and the percentage of that distribution is very, very important because it increases every year.
Yeah, for sure. Well, I'm giggling here as I look because
Just shaking his head.
from the angle that I am looking at Uncle Sam, his head has just been going like, yes, 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 the whole time you've been talking.
Yeah.
Answer
Well, you
is
know, I
like,
think it's a very symbolic thing here because he's
Right.
very rarely saying the opposite.
Yep.
Very rarely is he saying, no, you keep that money,
Yeah.
right? It's always give back to me. We've never had a chance to take it. And so you're right. I think that the head bob is just a perfect illustration for
it's
today's
very comical from my
conversation.
angle. I'm not sure our viewers can see it, but it's moving a lot. All right, well, that brings us to the sixth and final trap. This is a huge one. Failure to handle RMDs from inherited IRAs properly. This is important because the rule recently changed. So can you talk about that?
Yeah, unfortunately, this is a very difficult conversation for a lot of people because this rule is probably one of the newest and biggest changes that happened. And so if you have the opportunity and we're given the great gift of inheriting mom and dad's IRAs, there are some ramifications that go along with that. If mom and dad passed away before 2020, then you were required to inherit, or you can take out that stretch option, which is taking a required minimum distribution, but it's on a smaller percentage because it's based off of the beneficiary's age.
Right, meaning you could have stretched out over the rest of your life as the child who inherited it.
Correct.
Yeah. Now, thanks to the Secure Act of 2020, that's not an option. You're now put in a window to where you have 10 years to take out all of that money and pay ordinary income tax on it. There's a couple exclusions in there. The biggest one is if the beneficiary is a minor. They have until they reach the age of majority, and then their 10-year bucket starts, right? Or if they are a disabled individual, as long as they are within 10 years of a difference from the original owner, they can continue it to the laws of previous to 2020 to where they could just stretch it out. But knowing and understanding how that works is unfortunately on you, right? It's not very widely talked about and something that a lot of advisors are talking about. Unfortunately, I think that a lot of advisors may not know the rules that come along with it. But if you have any size, really, I mean, you can have $100,000 in your IRA. If you have 2 kids and they're each making $50,000, if they don't know the rules and how it works and they receive that gift, well, now their money is worth less and your money is worth less because they just received a $50,000 income. Right? Sure. So they're now on $100,000 of income for that year, higher tax bracket. It's a whole different ballgame. And so I think that obviously the more you have, the bigger the need is for a plan. But even with the small accounts or smaller accounts, a plan is crucial because you don't want to put your children or your beneficiaries in a situation to where all the money that they get is worth less.
Right, exactly. Well, again, these 6 traps just highlight that there's so much that can go wrong. This is why we say don't try this at home on your own. If this is new information to you or something that we brought up, you're going, yeah, you know what, I need some help figuring this out for myself. This is why Ryan and Paige and the team of Your Wealth Advisors would love to be able to provide you with your very own complimentary written financial plan. To schedule yours, simply call 844-411-3050. Or again, if you'd rather connect online, you can scan that QR code and that will get you connected as well. When we come back, what if you're in the position where you don't necessarily need the money from your RMDs to live off of? What strategies can you use to help employ greater tax efficiency throughout your full financial plan? We'll talk about that when we come back.
Market losses aren't the only risk in retirement. One of the biggest and most overlooked could be the tax bill on your qualified assets, your 401ks and IRAs. As tax rates change, so does the value of your retirement income. A Roth conversion may help you reduce your exposure and create more predictability, but timing and strategy matter. Want to see if a conversion could be right for your plan? Take the Roth conversion quiz today. It's free, and it could help you make a more informed decision about your financial future. Scan the QR code on the screen or visit ywrothquiz.com to take our Roth conversion quiz today.
Welcome back to Your Wealth Matters, where today we've been discussing all things RMD related, your required minimum distributions. And if you've been hanging out with us, we just went through the 6 most common traps we see folks fall into when they try to do this on their own. I think safe to say we've scared enough people into realizing, okay, maybe I need some help with this, right? It's not something you want to go out alone. There's so many ways to get it wrong. I know one of the frustrations, you work with a lot of folks who've done a really good job of saving, and you even shared in your story earlier, you've met with folks who are like, but I don't need this money. I don't want the RMD. Unfortunately, it's required, right? So you have to take it and pay the tax on it. But what are some strategies that you're able to employ for your clients to hopefully help them create greater tax efficiency as it relates to this RMD piece of their puzzle?
Yeah, you know, two of the best tax strategies that for RMD planning out there, number one is your qualified distributions, your QCDs. And I think that this is an opportunity that if there's a charity that you love or a church that you really want to give back to where you can set aside some of that money from your required minimum distributions and gift it, if you will, to that charity and get that deduction while still reaching and maintaining the required minimum distribution that you're required.
Awesome that the QCD can count for the RMD, right?
It's a fantastic rule, and the limits just increased to really huge numbers for 2026. So that's another great opportunity of figuring out, well, what are my options? You know, another option is that they just don't need it, they don't want to take it, and they want to minimize the tax for their children. And so one of the things that we've looked at doing is what we call an IRA rescue plan, where you can take that money and you can put it into another vehicle, right, that will pay a tax-free death benefit. And then you have that ability to say, well, that tax-free benefit, life insurance, is going to be there to either pay the taxes, right, on your total value, or produce some tax-free income for your beneficiaries that they can pay it when it's right for them, right? So it's all about just what's right for you. What's the best option that is right for you, and knowing what it is. There's a lot of different other opportunities that we just don't have time to get into in this show, but I think that, you know, a QCD is a great option if you have that charity of choice or you have that church that you really are wanting to gift to, or if you want to take it to the next level and you want to figure out how to maximize your dollars to get what you've worked for to your children, then schedule a time to come into one of our offices and let us help you and show you how an IRA rescue plan would benefit your situation.
Yes, what we're trying to do is help you not pay any more in taxes than you are legally required to pay. So again, we got Uncle Sam here, has been shaking his head throughout this whole episode. Really, the rules are set up to benefit him, not you. But here's the good news. You don't have to settle for the government's tax plan for you. There is a better way. Any final words of encouragement to everyone watching?
Again, if you don't have a plan, if you have questions about your plan, you're not confident in it, please give us a call. We would absolutely love for you to come in, sit down, let's hear your goals. Let's create a plan that best fits you so that you can keep most of your money.
Awesome. Paige, Ryan, thank you both so much, and thank you for joining us today. Again, you're just one phone call away. We encourage you to reach out and schedule your time to receive your complimentary written financial plan by calling 844-411-3050. Or again, you're welcome to scan that QR code, and that will get you connected as well. Thanks so much for watching. Be blessed, and always remember your wealth matters, and the team of Your Wealth Advisors is here to help and serve you. We'll see you next time.